Good morning, ladies and gentlemen. My name is Aaron Lenkowski, and I will be your host for the next hour. The three firms hosting today's webinar have a deep understanding with regards to the business of dentistry, and we've come together today to talk specifically about transitioning from practitioner to retiree. There have always been numerous considerations in making that move to retirement. But now the new normal adds complexities and nuances the dental industry has not yet seen prior. So today we'll be discussing transitioning in this new normal. So before I begin, I'd like to first thank the New York State Dental Association, along with Bronx and Queens County Dental Societies, as well as the teams from all three host firms for helping in promoting this event today. Thank you so much. The format for this morning's discussion will be the following. I'm going to start by introducing all three panelists, and in turn they will introduce their firms, their areas of expertise, with brief presentations. After which we'll move to a Q&A session that will last for the remainder of the hour. We've been collecting questions from you, the guests, for a few weeks, and have chosen to address the questions that are most relevant to today's business environment, practitioner's environment. So if you have additional questions, though, that you'd like to ask the panel, you'll find a chat space that has populated along the right-hand side of your webinar software. When you send these questions, they will be sent privately and directly to myself and the other presenters. If we have time to answer them in the webinar, we will. If we don't get to those questions during the live webinar session, the respective firm to which you've asked the question will be able to address those questions by email later on after the webinar. Okay, so don't worry about that. I would also like to thank all of you, the guests, for attending today. It's great to have you here with us. And now I'd like to introduce our panelists for today's discussion. First, we have Mike Apalucci. He is a transition sales consultant with Henry Schein's Professional Practice Transitions Group. Ben Lake is a senior financial advisor with Altfest Personal Wealth Management. And Joe LaFerlita is an attorney and partner at Farrell, Fritz, PC, practicing in trusts and estates. Welcome, gentlemen, and thank you so much for making time to be here today. Mike, we're gonna start with you, and I'd love for you to update us on the business of dental valuations, practice valuations, and transitions in dentistry.
Hi, Karen. Good morning, everyone, and thanks so much for taking time out of what has suddenly become a very busy scheduling process for all doctors. My colleagues this morning have asked me to talk a little bit about the current transition trends. We're going to do that both from the trends going into 2020, and then of course we'll try to look at what's happened since the practices have all been closed down and with doctors just going back at this particular time. So good, we're ready now. So anyway, let's talk about, if we go back as we enter 2020, what the trends look like in transitions, quite frankly. First of all, it continued to be a seller's market. In fact, it's been a seller's market nonstop for 6 or 7 years. The fair market value continued to grow. And one of the reasons probably is the fact that we have such a buyer pool out there right now and not enough practices to meet the demand. Practice values across the country generally are running between 50 and 80% of last year's gross. Now that's the highest we've seen, particularly on the East Coast, over the last 10 years. It continues to be higher in other parts of the country, such as California, Northern Virginia, where they're getting somewhere between 100 and 115% of last year's gross. We saw specialty practices suddenly come back into the market again. So for a while, there was a real lull. Now we saw endo, oral, perio come back. The only areas where we're still having difficulties would be in orthodontics and perio. And probably one of the reasons we can't get enough practices is the fact that perio and ortho tend to have associates working already for a longer period in the practice, and the seller or the owner has already started to do a buy and buy out process with them. Some other trends that we saw, doctor partnering continued to be very popular. So this is where doctors get together. They each own their own practice, location-wise, could be wherever, but they've always wanted to work together. Perhaps they were dental school roommates, and they get together and buy a practice together as 50-50 partners. So that suddenly allows them, really, the objective would be eventually they're going to merge all the practices. They'll become full partners in all three. And eventually they're going to probably change the name and brand them. And speaking of branding, very popular, continuing last year going to this year, sole practitioners. So owners who own a practice or two were looking for a second or a third practice. And we call that the triangle demographic. And that's where a doctor may own a practice at the bottom left side of the triangle, may own a practice at the top of the triangle, and now is looking to buy a practice at the bottom right side of the triangle. And guess what? The doctor lives right in the middle. So it gives the doctor a much easier way to manage all three locations. And at the same time, maybe add dentistry and procedures. It gives that doctor a much easier way to get to all three locations. Very popular. And finally, we saw increases in the multi-doctor relationship purchase. So a general doctor goes along with a specialist, they become partners, they buy a practice together. Obviously, the thought here is that it's almost like a DSO model. This would be a mini DSO. It would be the opportunity to give patients one-stop shopping at one particular office. Now, as we look at the current trends, 50% of doctors nationally will now be over 70 years old. And that is effective as we go into the month of July. So it's coming fast. Here's the key number: 40% of doctors nationally are now ready for transitions. Now, that could be doctors who may be 58 years old up to 70. But generally, what that means is there's a chance that they might be selling their practices or retiring within the next 2 to 5 years. That's a substantial number. If you look at the types of practices out there from 2016 to 18, higher grossing practices hitting the market increased by about 20%. So that's practices grossing maybe 1.5 million and above. Same time frame, practices grossing 400K to $1 million, they hit the market with an increase of about 16%. As we look into 2019, that just, as it passed, all these numbers probably were went up by about 5% nationally. So let's look at some of the current trends that we're seeing. The ADA HPI just last week did a national webinar where they actually introduced these numbers. The question to all the doctors nationally was, what do you intend to do in the next 6 months? 72% said, I'm going to reopen my practice. About 13% said about sell my dental practice. So they outright made the decision they're going to do that already. About 5% said, I'm done, I'm walking, I'm just going to file for bankruptcy. Outright retirement, about 16%. Now, that's a wide range. As we're seeing, for instance, in Manhattan right now, a lot of smaller practices, doctors are just decide they're not going to go back at all. They're just going to walk from the practice or perhaps sell their patient files. This could also mean doctors who have gone back to work already. In some parts of the country, like Georgia, Florida, they've already been back to work, probably about 5 weeks already, 6 weeks. What's happening, doctors go back, they start the practice up again, and they find out that, geez, I don't think I can do this any longer. So they make the decision at that point that they're probably going to make a retirement decision at this point. Or again, that could also mean they may want to move forward and sell their practice. Are you going to affiliate with a DSO? Only about 2.4% said that they were going to look to a DSO in this current post-COVID atmosphere. And finally, about 6% said, I'm done with dentistry. I'm going to go into, I already have another career on the side. I'm a painter, whatever, but we're going to walk away, 6.5%. So our transition conclusions after COVID-19. Hey, so far it is still a seller's market. Despite all the rumors and the hoopla out there that it is now a buyer have taken over. Even the experts predicted that. We are not seeing that. In fact, keep in mind, though, that there are sharp increases in doctors who have said that they're contemplating what they're going to do. Do I want to do this? I'm going to go back to work for a few weeks. Meanwhile, they've got practice valuations completed to help them make that decision. So, and again, at this time, do we really know all the transition trends? Perhaps the buyer market will jump in as we go through this year, but that remains to be seen. One last thing, the ADA HPI latest survey, and keep in mind, 90% of these respondents already have opened their practices back up. 19.7% have opened with business as usual. That's pretty, I think it's a lot higher than was anticipated. Only 4% said they opened with lower patient volume. Now, that is really amazing too, because we know that there's probably going to be a production, a little shift in the beginning because of the fact that we have to follow the CDC, the ADA requirements. So that's not that bad. 57% of respondents had patient volumes of 51% or more. So that's much higher than anyone thought at this point. And 40% said they had total collections of 50% or more. If you track that out, that means the doctors are right back on schedule to be back on revenue plan by the end of the year. And finally, 77% of all respondents are fully paying their staff, which is good. So that's a look at the trends. Aaron, I'm going to send it back to you at this point.
Okay, great. Mike, thank you so much. Those are some really interesting numbers, especially when it comes to the retirement numbers that you speak of, or bankruptcies in the industry. It's a nice transition where I'm going to now turn it over to my friend and colleague, Ben Lake, to talk about Altfest Personal Wealth Management and the important work that we're doing with our dental clients. Ben, good to have you.
Thanks, Aaron, and thank you all for joining today. It's a pleasure to speak with everyone. Certainly, we've been in a rather exciting time to be alive and be focused on helping people in the dental community. And I think that Mike brought up a lot of really good points today, and I want to build off a few of those. I thought it was particularly interesting, some of the statistics around how people are thinking about selling their practices or transitioning into retirement, or maybe a little bit of both. And at Altfest, what we do is we help people with all of their kind of comprehensive financial planning and also their investment management. And so that really means in this kind of time frame that what we're focused on is helping people who might be considering either a slightly earlier retirement plan or just making sure that they have a plan in place for their longer term goals, whether they're focused on retirement or legacy building, anything of that nature. And we do that obviously from a fiduciary fee-only manner. So we're really only acting in the best interest of our clients, and the processes we've built around that financial planning and investment management services. It's been around for 36, 37 years now. So I think that one of the really important questions is how have things changed for each individual listening today? What questions need to be asked? And if it's a simple question as can I retire? How confidently can I retire? When can I retire? There's a lot of different ways to address that question. So what we want to do is look at all the different aspects of someone's finances, what goes into the retirement plan, and help really optimize each part of that to help that person reach their goals. And so today I want to focus a little bit on things related to investments, tax planning, retirement, and obviously career transitions. There's certainly a lot of other things that can go into it. And obviously, if you'd like to follow up with Aaron or one of our colleagues directly, we can discuss things that range from insurance planning to benefits and all kinds of different aspects of the financial plan. But today, I think a couple very important things to highlight are what's changed, right? What's new in this post-COVID environment. And certainly one potential issue is that as dentists are considering whether or not they want to sell their practice, open back up again, retire sooner rather than later. One thing that's particularly important is to understand that with their portfolios, retirement accounts, your liquid, your taxable assets, if you're considering retiring early, it's important to recognize that there are potential risks. And one of them I want to highlight here on this chart is what's called sequence of return risks. which essentially indicates that if you use kind of a long-term static projection of what your future expenses might be, what your withdrawal rate portfolio might be, and you match that to a static assumed annual rate of return. In this case, the purple line is showing what exactly that looks like with an assumed 5%-ish withdrawal rate and an 8% average return over time, which matches the historical averages. You get this very nice steady curve. You get this very high level of confidence from looking at it like that. But the problem is, if you have a period of time where you're retiring and the markets are a little bit more volatile than they are historically, as they might be this year, obviously, and potentially going forward. And I can get into the outlook momentarily, but one thing that's happened in the past is, in this time frame being shown here, if you have weaker or more volatile returns early on in retirement and you don't adjust your withdrawal rate strategically, or you don't have a plan in place to account for that, you may actually wind up running out of assets much more quickly than you otherwise would have expected. And so that's what this green line is showing, is that if you actually retired in a volatile market back in 1966 and didn't change anything about your plan, you actually may have run out of money by age 90, whereas other projections might have shown you could have over $1 million in your late 90s. And so that's one thing that I think is very important to realize, is that it's important to be fluid. It's important to have an overall strategy, but be able to be flexible within it. And then on top of that, you also want to make sure that you're not just making these massive portfolio decisions based on just what's going on this month or next quarter or even the next 12 months, because really anything can happen in a short time period. You want to have a much more long-term investment plan in place, something that's well thought out, that matches your goals and matches your risk tolerance and your capacity to take on risk. And so, one thing that's being highlighted here on this next chart is what can happen over a full market cycle. So this is going back to the peak of the markets in 2007, obviously showing what happened during the Great Financial Crisis in 08, the 10, 11-year recovery, and then into now, we've had this more recent pullback and recovery already. But what's happened is, if you had just kind of held stocks, right, the S&P 500 is the overall US stock market, obviously you experienced a very significant decline, a 55% decline, peak to trough in 2008, and it took about 3 years to fully recover. You didn't recover back to even until March 2012. But obviously, if you held on, it would recover very significantly since then. However, that's very difficult to stomach. I mean, I think human nature really is that when you get into periods of stress like this, especially with life savings, retirement savings, and financial markets, it can be easy to be predisposed towards making decisions of your investments that might be based more on emotion and comfort rather than a disciplined investment process and those kinds of longer term things. So the other two lines here are showing are a more conservative 40-60 blend, 40% stocks, 60% bonds in the dark blue line, and a more moderate 60-40 blend of stocks and bonds in the light blue line, and showing that if you had a more diversified approach and held onto it, didn't overly change things throughout this time period, you were obviously down quite a lot less in 2007, 2008. You recovered much faster years earlier by having more diversification, more ability to recover quickly. And then even through this recent bull market, even though obviously it wouldn't have outperformed along the way, now that we've had another pullback and we're back to another part of the cycle, these three lines are roughly in similar positions. So again, this is just one way to highlight this, but I think one important lesson to learn from this is what actually happened. What did people really do in terms of the average investor experience? And so this next chart here is showing that over 20 years from 1999 to 2019, right, kind of tech boom and bust through the Great Financial Crisis through today. Here's how all these different asset classes did, right? REITs, real estate investment trusts, did very well in this time period. Gold and obviously the S&P 500 and these two moderate and conservative portfolios actually all wound up in roughly the same place in terms of an annualized average return experience, being between 5.4 and 6.1%. Things like bonds, commodities like oil, international stocks and homes all did a little bit lower, but unfortunately the average investor, again, who often human nature, we're prone to making less rational, more emotional decisions sometimes, the average investor actually only experienced gains of 2.5%. So actually underperformed all of these asset classes and basically barely beat inflation. And that's really, one of the big risks and one of the big lessons to learn from this most recent couple decades of experience we've had, is that you want to stick to a disciplined investment process, but more importantly, you want to have a plan in place that you're comfortable with, that meets your goals, and that you're able to use to basically really achieve those long-term views. And so, we can talk about all kinds of different things about what's going on now, how this chart might change going forward. Certainly people may view this as obviously a very challenging time in many different businesses, but over the long term, it may also be a potential buying opportunity in some areas that have become more attractive. Happy to talk to some of those in the Q&A perhaps, but for now, I'll pause and throw it back over to Aaron.
All right, Ben, thank you so much. I look forward to asking you some questions in the Q&A. I'm going to reintroduce Joe LaFerlita with Farrell, Fritz, PC. Joe, I'm excited for your information. I'd love for you to tell us a bit about your firm and the important estate considerations for dentists, maybe even particularly New York State dentists, they need to be aware of when transitioning into retirement. Joe, thanks for being here.
Thanks for having me, Aaron, and I'm glad you're excited about my presentation. I'm not sure anyone else is, but I'll take one. I am a partner at the law firm Farrell Fritz. We're a regional firm. We're rooted primarily on Long Island, but we serve many clients in the tri-state area. And we have a Manhattan office, East End office. We have an Albany office, and we work with all sorts of people trying to, plan their estates, manage their businesses, and ultimately what I focus on is estate planning and working with families of loved ones who have died. When we talk about the do's and don'ts of estate planning for New York dentists, there's really one thing, if I could boil it all down, there's one thing that I've observed over the last 16 years in working with, from my vantage point, working with families who have lost loved ones, particularly a loved one who was a breadwinner, someone who either through hard work or good stewardship left this earth with some amount of assets. And the one do that I've learned is that advanced, thoughtful preparation makes all the difference. It's really that simple. It's about advanced prep. We've heard the truism that there are only two things in life that are certain: death and taxes. And that may be a dim way of looking at things, but it's very true. There's an element of truth to that. And as an estate and trust attorney, sitting down with individuals such as the people listening to our presentation today, plan for their retirement or their demise. That's actually only part of what I do in my profession. The other part, again, is sitting down with the surviving spouse after the death of the loved one. That is where the rubber meets the road. That's when the real test comes as to whether the correct and the appropriate preparation was done. So what I'd like to do today is talk about some issues that frequently come up when I sit down with that surviving spouse or the children of the deceased. And I think it'd be helpful for the listeners today. And I think there are two main categories that we should focus on. One is your assets, leaving your assets to the people you want to leave them to, or to the charities, the institutions that you want to leave them to in the appropriate way. Another way, and we'll talk about that in a few minutes, is how to do so in a tax efficient way. Okay, so how do we make sure that your assets get to the appropriate persons in the appropriate manner? Well, there's one thing that you have to be mindful of, and if you don't plan, while there are default rules in place as to who inherits your estate and how they inherit it, those don't rely on those default rules, because they're actually in many situations they're counterintuitive, unfortunately. So, for example, if you are married and you have children, one would think that if you die without a will or doing the planning, that your assets will automatically pass to your surviving spouse. That's actually not true in New York State. The laws of every state are different, but in New York State, the first $50,000 of one's estate goes to the surviving spouse. The rest of the estate, everything above $50,000, is split 50-50 among the surviving spouse and the children. So that is unfortunately an eye opener, sitting down with the surviving spouse who realizes all of a sudden that half of her wealth is gone because her spouse passed away. Another thing that often comes up is the beneficiary designation form for one's retirement account. You may name your surviving spouse as the beneficiary, and then if your surviving spouse predeceases you, you may have your children. The problem is if one of your children predeceases you, you would think leaving children. So you have grandchildren of that predeceased child. You would think that your grandchildren, the children of your predeceased child, would take his share, the share of their deceased parent, your child. That's actually often not the case. So if you have two children, okay, one of them predeceases you, and you named your two children as the beneficiaries, the surviving child, under many plans, the plan documents, will inherit 100% of your retirement account, leaving out in the cold your grandchildren of the predeceased child. And that's important because today more and more significant portion of one's wealth is tied up in retirement assets. So something to bear in mind. There are lots of other situations that go beyond that. One of them, one of the primary concerns that I hear in meeting with people doing their planning is that they're worried about their children someday getting a divorce. And so how do they're worried about that in-law getting the money. And that's a valid concern because, there is some protections. Generally, inherited assets are not subject to equitable distribution on a divorce. But if your child commingles the assets with his or her spouse, all bets are off. So there's a real concern there, and it sometimes becomes a problem. There are other clients who have children or loved ones who have special needs. Okay, what do you do in those situations? Just because a client may have significant assets and is fully able to pay for the proper care for his disabled child, that doesn't mean that he doesn't have to worry about Medicaid planning. There are many programs out there that only accept members who are Medicaid eligible. So unfortunately, I've seen situations where a wealthy client leaves his estate equally to his children, and that one child who had special needs now became unable to get the benefits that he or she really needed. And so there are things we can do. There are certain types of trust, special needs trust, that we could deal with that. Another common situation involves second marriages. So the client has children from a prior marriage, or both clients have children from prior marriages. How do you ensure that you can take care of your surviving spouse, your second spouse, while not leaving the children from the prior marriage in the dust, okay, in the cold? And there's a lot of litigation that comes up just from that fact pattern. So again, there are things that we can do to account for that, to plan for that, to avoid the litigation down the line and the bitterness. Creditor problems or addiction problems, okay? You want to be careful to not feed an addiction. So and that happens all too often, where your hard work, you want to pass this legacy on to a child or to a loved one, and others are able, because of creditor situation, are able to get their hands on it, or unfortunately, you're enabling some bad behavior by your loved one. Again, how do you balance that? How do you provide for your loved one without making matters worse? Keeping children motivated. This has come up more and more lately in the last few years. People are worried about creating trust fund babies. How do you ensure that your child remains motivated to be a contributing member of our society? That's there are a lot of things to talk about there. And one of them may involve not telling your children about the wealth that is there. Others might involve putting benchmarks in a trust so that the child can't get certain distributions unless the child is gainfully employed, or whatever measurement is appropriate in that situation. And then finally, what about a situation where you expect a will contest is expected? So there's a disgruntled family member, and that's really a big red flag. And the more we learn about that in advance, the more we can plan to try to avoid a will contest. And there are lots of strategies to employ. So those are just some situations, some red flags that I've seen where you really need, if you have one of those situations, you really need to plan, and to not plan can be disastrous. Let's talk about getting the assets to the children in a tax efficient way. Again, death and taxes. Well, unfortunately, the type of tax that we're talking about right now is a very expensive tax. You have, what am I talking about? I'm talking about the estate tax, the gift tax, and the GST tax. GST is generation skipping transfer tax. A lot of clients, even sophisticated clients, have never even heard of this tax. It's a tax that comes into play when you leave assets to grandchildren, okay, or people who, even if they're unrelated, are more than 37 years younger than you. It's essentially a second level or layer of estate tax. Right now, the New York estate tax exemption is $5.85 million. The federal is $11.58 million. Okay, so those are historically very high exemptions. But we can talk about, that shouldn't give you too much comfort, because actually under current law, that exemption, the federal exemption, is scheduled to be cut in half in 2026. And that assumes the law isn't changed before then. And of course, we're in an election year. So depending on how things turn out in this election, the tax laws can be changed before 2026 in a negative way from the taxpayer's vantage point. The rates are very high. So the federal rate currently is 40%. So if you're over that threshold, 40% of the excess is going to go to Uncle Sam. Okay. In New York, it's 16%. So dying, again, can be expensive. That tax is due 9 months from death, okay, in cash. So that's another whole element that, you have to plan for, liquidity. And people like Ben and Mike, frankly, when there's a business involved, a practice, you need to think about when can you convert that practice into cash. So those are some things to be mindful of. Now, one of the things that, one of the tools that is most helpful in estate planning is a trust. And I get the question all the time, should I be creating a trust? Okay. And the answer is probably, but we have to know what type of trust we're talking about. Okay. There's no canned answer here. There are revocable trust, irrevocable trust, grantor trusts, life insurance trust. The list goes on and on. We have to first focus on what your goals are. What are you trying to achieve? And again, most often trusts play an essential role in a prudent estate plan. So what can trusts do? Well, one of the things trusts can offer are tax benefits. They're a way to essentially get assets off your balance sheet, okay, and into some other entity that benefits either you or your family. So you try to have your cake and eat it too. You try to get the assets off, but still maintain that benefit. There's always that tension there. And the IRS, of course, is always looking to attack that, okay, because they want to move the assets back onto your balance sheet. Trusts also can offer creditor protection if done properly. And by creditor protection, I mean protection from your creditors, but also protection from the creditors of your loved ones. If you're concerned about privacy, their trusts can solve that problem, because as you may know, probate proceedings are public proceedings. Anyone can go down to the surrogate's court and look at the file and see what one's assets are. And then finally, I mentioned before, probate contests. Sometimes trusts could play a role in minimizing the chances of a probate contest and avoiding that probate proceeding altogether. So again, these are just basic things to consider. The motivation should be preparation.
Right. Joe, thank you so much. That was those were some interesting points, and I know we have a few good questions that came in from the audience with regards to trust and estates that I definitely want to jump into. We're gonna go back to the top of the queue, so to speak, and I want to bring back in Mike Apalucci because there were a lot of questions that came in with regards to evaluating a practice. As you mentioned, Mike, there are a goodly percentage of practitioners that are looking to sell their practice. Some might even be declaring bankruptcy, as we now know. All these things come into play. And when I talk to our dental clients, we sometimes talk about, do you know the value of your practice? And that's a big question mark. So can you tell us why having a certified practice valuation completed is important to doctors, to dentists in the industry?
Yeah, sure, Aaron. That's a question, obviously, it comes up all the time. I think most doctors assume that when you get a practice valuation done, it's because, again, you are ready to go to retirement. You talk to Joe and Ben, and they give you the green light to move forward. And the first thing you want to do is have a valuation. And that is true for that perspective. But we actually have a list of the top 10 things that you should do in order to have a valuation done. But what we tell all of our doctors who own a practice, whether they have a brand new practice, they've been there 15 years, they've been there 40 years, the first thing you need to do is have a letter of instruction written to your family. That's number one. And that tells the family, how do you deal with the sale of the practice in case of a sudden career-ending disability, or even worse, death in the family? What do you do? So it's a place where everything is assembled so that the family, God forbid if this happens, can get right to it. It has everything from your attorney's names to the staff names to the credit card. Everything about the practice is locked in there. That's the first thing that you should have. In fact, if doctors have not done that, just email me and I will send you a Henry Schein template, allow you to fill all that information and be able to put that away. Now, part of that letter of instruction, you really need to have a practice valuation sitting with it, because you're going to need that if the family has to sell the practice quickly. And the main reason is, in case of an immediate sale, 30% of practices will sell within the first 90 days of death or disability. Only 10% are going to sell after 90 days. And 60%, if they don't sell, in 90 days, there's a good chance they will not sell at all, or you're going to be looking at a potential fire sale for what is left of the practice. Again, one example is that, in this COVID situation, we've had at least 3 doctors in the New York area who unfortunately passed away. All 3 of those doctors, we had to get valuations assembled very quickly. And the amount of information that goes into the valuations, all the financials, all the other information of building the documents, it really takes time to do that. And you don't really have time because the clock is ticking. So just, I would say, get a letter of instruction done and absolutely consider having a valuation done right now. Hope that good helps out, Aaron.
Great.
Can I jump in on that for a sec?
Please.
I thought Mike's answer was really helpful, and I just want to reiterate. Talk about fire sales, and that is something that I encounter from time to time after the death of a loved one, when the estate doesn't have the liquidity to pay the estate tax. And again, I want to reiterate, estate tax is due 9 months from the date of death in cash, and there might be grounds for extending that with interest, but the IRS in New York State isn't so quick to grant that. So having that valuation done while you're alive to work with the appraisers is very important.
Right. Okay. Thanks, guys. I want to piggyback off that a little bit because there's been a lot of questions that have come in with regards to early retirement. We even saw some facts that Mike provided that, again, I'm after this COVID pandemic, I'm just going to go retire. Maybe they were thinking about retirement before the pandemic hit, but now it's kind of sealed the envelope for them. I'm going to turn to my colleague Ben. How has COVID-19 impacted the opportunity for dentists to retire early? Early retirement. Can you speak to us about that a little bit?
Yeah, definitely, and it is a very, very common question we get from a lot of our clients, both dentists and otherwise. I think that one of the main questions has become, is it even worth it to reopen? Right? Are there any other costs that are going to be associated with getting the actual physical office prepared for clients to feel comfortable coming back in again? How is income going to change? And do I feel safe going back into practicing at the moment, or should I just kind of transition into retirement? So I think there's a lot of big questions about personal preference, and then obviously the costs, the objective kind of cost benefit analysis. And so, obviously there's been a lot that's happened this year that obviously is outside of just the COVID issues themselves. So, for example, there's been several different stimulus plans that have been put forth by both the U.S. government and internationally, and obviously the Federal Reserve as well, trying to help people maintain employment, maintain their businesses. So a lot of that are things that we've been able to help people with. And this year's also created a number of potential tax planning opportunities because a lot of the tax laws have changed with regards to how people are using retirement accounts. Obviously, if you have a lower income year, there's a lot of potential planning opportunities to create strategies to really just maximize where you're getting your tax benefits and when. And so a lot of that is really important to have in place, have the plan already there when you're considering retiring sooner than you otherwise would have, or if you just want to have the plan for retirement in the longer term. So those are a few main issues. I think one of the other obviously very important things that I mentioned in the presentation is making sure you have your investment plan, especially when it comes to having both the plan for your liquid retirement assets, maybe your taxable investments as well, but also the illiquid portion of your net worth, right? If you have obviously the valuation of the practice, something we were talking about a lot, how does that factor in to your retirement plan? How do you kind of use that to boost the confidence that you're going to have? And so putting all of that together, I think, is extremely important in this environment. And so that's why I hope all of us here have been helpful so far for answering those kinds of questions.
Okay, great. Now, I want to do a quick follow-up before I turn back to Joe. What if it's not a decision that was made? I referenced, maybe January, February, I'm thinking about retirement, but I come back to my practice and the numbers just aren't making sense, and it's more of a forced retirement. What are the first couple of things that should be done when a practitioner is in a forced situation to retire early?
Yeah, that's a great question, and it is a situation we've now faced a few times with our clients. So a few of the most important things, some of which I already mentioned, are getting a handle on what is in the balance sheet, right? What are your both liquid assets that might be easy to value, maybe your illiquid assets that are not so easy to value. Would it make sense to then also review your cash flow? I think the cash flow component is extremely important, right? If you're maybe thinking about delaying Social Security and taking that before you wind up needing to take money out of your retirement accounts, how do those two things kind of work in an optimal fashion? What's the best place to be withdrawing assets from if you need to withdraw at all? And how are you getting other sources of income? Right, some of our dental practices actually created pension plans for themselves. This is more of a defined benefit as opposed to a 401k. So it really starts with understanding basically what's in the balance sheet, and then what's involved in your cash flow, how to then take that information and optimize it around what your lifestyle is, what your goals are, and certainly your tax situation. And then making sure that you're more set up again for those longer term questions like, do you have an estate plan in place? Is there a plan for selling or transitioning the practice? Making sure you have the right kinds of insurance, and certainly there's a number of other factors as well. Obviously, healthcare being a very important one. So making sure you have the right planning documents, estate planning documents for any kind of healthcare needs, dual powers of attorney, those things of that nature. And then certainly also if there's a need to transition from the current employer provided health insurance you might have to something that's more either Medicare or Medigap based, are all kind of other things that often get forgotten about, but are very important to be aware of.
Interesting. Great. Thanks, Ben. So speaking of that transition, I want to turn to Joe because there's been quite a few questions that have come in with regards to estate planning. A lot of questions talking about the estate tax exemption being as high as they are. There's one example of a question that came in. Practitioner's worth about a certain amount of money, I think about $8 million. But with the exemption being 11.58, I believe, per person, and given that this practitioner, Joe, is worth about $8 million, do they even need to worry about estate planning?
That's a very good question, and you're right. The federal exemption, the estate tax exemptions are at historic highs. I mentioned before the federal exemption is 11.58 per person. And New York State, which has its own estate tax, has an exemption of 5.85 million. So when you look at it, that dentist you mentioned is worth 8 million. He's certainly below the federal, but he is above the New York State. So first answer, there's a couple of things I want to say there. Number one, you might be safe from the federal, but he's not necessarily safe from the New York. And the tax, the New York tax on an $8 million taxable estate is probably, 775,000 thereabouts. It's going to be, well over $500,000, slightly less than $1 million. That's a significant amount of assets that could of assets that tax that could be avoided, with some basic estate planning in place. So that's part one. And part two is, and this I think is more important for that dentist to realize, estate planning encompasses much more than estate tax planning. Tax planning is a significant, but just a part of estate planning. I mentioned before lots of other family situations. Again, divorce, addiction, probate contests, and so there's a lot of planning that needs to take place, especially for dentists. Dentists are professionals, okay? You can't just leave your practice to anyone, okay, to any child or to any loved one who's not a dentist. What do you do with that situation? Dentists and lawyers share that challenge. It's not like you own a pizzeria and you can leave the pizzeria to just about anyone you want. So planning encompasses much more than taxes.
Right. Joe, thank you. There's actually a follow-up question that I want to get to after quick questions from our guests, but we'll circle back with regards to equitable distribution because there's been a lot of concern about that. So we're going to go back to Mike in a moment with a second question. But ladies and gentlemen, the guests in the audience, we want to ask you. I know there's probably some considerations, some questions that you might have that you'd want to ask maybe each of the member firms today, off on the side in private, perhaps next week. So we're going to launch a poll, and this poll is, the answer is private. It's kept privately. But if you'd like to speak to Henry Schein about transitioning, if you'd like to speak to Altfest about retirement planning, or Farrell Fritz about estate planning, our firms will reach out to you privately sometime after the webinar and consult with you on questions and concerns that you may have separately and not want to talk about here in the chat. So please go ahead and answer those questions. That question will leave the poll open for maybe 30 or 60 seconds for you to answer. Again, it's not shared with anybody. It's just kept between the member firms today. So in that, while the guests are answering that question, I want to go back to Mike with regards to the current COVID environment and the valuation of practices has been a big question. Normal business environment current, is certainly has not yet been achieved. So could you talk to us a little bit, Mike, about how valuations are being approached in the current COVID environment? Personally, I wanted to ask, I'm assuming you have to go in and take a look at the practice. And up until recently, that couldn't have been achieved very easily. So how has all that been with Henry Schein? How's that coming together?
Yeah, another popular question right now, Aaron. Quite frankly, the way the valuations are set up is that it's based on really the finances of the practice itself. So generally, we're able to assemble all the information outside of the office ahead of time. Normally, then we sit down with the doctor at that point, but generally we're doing it virtually right now. And how we're doing valuations is we're taking them up through the end of 2019. Now that includes, 19, 18, 17, and 16. We're looking at a 4-year scan of the practice, and that was during its healthy times, quite frankly. Also, we would not start doing 2020 valuations until actually beginning of next month, July, because you really need at least 6 months of financials in order for us to really get a good assessment. In fact, we've just moved that up now to really doing 2020. We'll probably move that up to the third quarter to get those done. So right now, doctors who need to establish a sale price because they're selling immediately will take their valuation up to the end of 2019. Now, what that means is we'll deal with the other adjustments, which could be the first 3 months of 2020. And by the way, doctors I've been talking to, almost everyone, to the person, has had a great first 3 months. Some doctors said they have record first 3 months of 2020. So that's all going to bode well for speaking to buyers out there. That's what a lot of folks who are selling right now. And again, we'll make adjustments based on the purchaser demand as it goes forward, and also the desire to sell at that point. So there could be a little bit of a flip up and down on the valuations, but we're going to the end of 2019, and that's what we're looking at, the most robust time right now.
Okay.
I hope that.
Yeah, great. Thanks, Mike. Ben Lake, I wanted to talk about going back to your slide presentation. Probably my favorite slide out of the few that you talked about is portfolio expectations. My work at Altfest, I kind of, as you know, introduce people to the firm and what we do comprehensively with wealth management. But you're in the trenches. You're firing the guns every day. You're doing the heavy lifting. So talk to all of us about common mistakes when we onboard new dental clients. What are the most common portfolio mistakes that we see amongst dental clients, and even just generally medical practitioners that are out there?
Sure. I think there's a few potential themes to pull out of our experiences with reviewing people's investment portfolios as they're becoming clients of ours. I think one in particular that fits in with what I was talking about earlier is that many people really don't know or fully understand the amount of risk that's present in their portfolio. Right? They haven't necessarily looked at it in a while, or maybe they were doing it themselves or not doing it themselves, but didn't necessarily have the best sense of, okay, well, here, what are my targets in the first place, and here's where my real risk exposures lie. So, understanding that you have a certain amount of exposure to stocks and equities versus fixed income versus other kind of alternatives and alternative strategies might be a first kind of step to make sure that the client recognizes what their overall level of conservative or aggression is, and that they're comfortable with it. Right, making sure that's something that they're happy to stick to in case things do get more challenging or if things get more exciting, which we all hope for, obviously. And then another is really making sure that they're well diversified. We've seen all kinds of different situations where maybe a person only has 3 stocks in their entire portfolio, and maybe that worked out great, maybe it worked out not great at all. But going forward, that's really probably not what you want to be doing with your retirement savings. You don't want to be relying on the success of only a few companies or even one industry for your future financial success. And another on top of that, in terms of the diversification question, a big thing that we really see very frequently is that many people by nature really only focus on investing in the US. And we look at things much more globally and much more, kind of with a fine-tooth comb. And I think that's particularly important in this environment. The US and the international markets, international developed and emerging markets, generally speaking, kind of take turns over time, leading each other and lagging each other, but they often wind up in roughly a similar place over a full market cycle. But more recently, in the last maybe 5, 6, 7, 8, 9, 10 years almost, the US markets have outperformed very strongly. But as a result, international and emerging markets are much more attractively priced. The valuations are much lower. And as we start to reopen across the world, obviously we're already starting to see signs that there might be a second wave of increasing cases here in certain parts of the US, right, in the South and parts of the West. In other countries, maybe it's true to some extent, but the vast majority of them have actually kept it much more under control. And we'll see how that evolves, obviously, but one thing that our investment team has been quite focused on is trying to understand what are the best opportunities to essentially buy things that are undervalued or underappreciated in the global environment right now, in the global markets. And I think a lot of that could really well be on the international and emerging market front. So that's one I'm particularly focused on at the moment. And then maybe one last minor comment on this is helping people understand what the tax implications of their portfolio is, right? If they're using most of their taxable assets properly, or if they maybe have used or maybe underused their retirement accounts or tax advantaged accounts, those are the kinds of things that there are often a lot of planning opportunities around, making sure that it's done in the most tax efficient way possible.
Interesting. So really, you've given a scenario for why the purple line was as nice looking as it was on your slide versus the green line. Over concentration in one area, less diversification in the market, and plus you're drawing off of those assets to live because you're no longer in practice. That's great. Thank you so much, Ben. I appreciate it. A big question that came in, and this is probably going to be our final question of the day, but we'll see if we can get to some more about equitable distribution, Joe. There's a practitioner that wants to treat his children equally in the event he passes, but the largest asset that he currently holds happens to be his practice, in which his daughter a few years ago started working as a young dentist. He would like her to have the practice, but the son is not a dentist and feels that he can't leave any portion of the practice to him. There's a conundrum there. There's a question mark. What is there a way to equally distribute the estate?
Well, that question really relates back to one of my response to the prior question about taxes, and this is a perfect example of where estate planning involves more than just tax planning. This and it also relates to my comment that you can't just leave a dental practice to anyone, and that does present a challenge to planning for dentists. So what do we do in this situation? Well, typically we try to look for other assets. If the client is dead set on leaving the practice to one child and not the other, are there other assets to balance that out? And in the fact pattern that you read about, it didn't seem that was possible, because I'm assuming that in that case the dental practice constituted most of his wealth. So what does he do in that situation? Well, that's a situation where we might look at life insurance, so hopefully that client, that individual, that dentist is insurable, and perhaps there's some life insurance out there that is affordable enough to create wealth to balance that out for the children, and of course we'd want to put that in a life insurance trust, most likely to prevent further taxation on the insurance proceeds. Let's assume the client is not insurable, and sometimes that happens. what we can do is put in place some sort of a formula whereby the estate is divided 50-50. The practice is left to the dentist, the daughter, and she may have to pay out her sibling over time, and we can set it up so that there's a payment plan where she's drawing down income from the business, from the practice, in a way that won't cripple her, won't cripple the practice, and that perhaps is another way we can look at keeping the estate equal among the children. It is a challenge.
Mm-hmm. Okay, interesting, great. Thank you again, Mike, Joe, Ben, for being here this morning. We're just at 11 o'clock. I know there are questions that came through that we did not get to today, but we will answer them via email after the webinar is concluded. Thank you so much again for everybody that registered and came in to hear us speak today, and we look forward to catching you again. Gentlemen, thanks again, and we'll talk again soon, I hope.
Thank you. Take
care. All right.